So today, let me,
Cool.
please give me the honor to introduce the speaker who is on the line right now, Ian Tai. Now, he's a founder of bursaking.com.my, which is a platform that provides you tools and materials, as well as to promote value investing in his online community. Currently, he serves a community of 4,300 retail investors. Wow. I mean, you have a large following, don't you?
Thank you. Thank
So,
you.
he's also a founder of bursakingwebinar.com. He's a columnist of kclaw.com, the fifth person and the Value Invest Asia. And he's famous for dividend investor. He invests primarily for dividend income. And his average portfolio, is it your average portfolio yield? Is 6.5% per annum, okay? So, which is what looks very incredible. So, having said that, I think Ian did not put it in the slide, is that he's also author of 3 books, right? Am I right? Yeah, he's
Yes,
a
yes,
famous
yes.
author for 3 books, okay? So if you
Not famous
chance
lah, but
upon,
author, yes lah.
you chance upon his books on the bookstore, which is, what are those books? Invest in Gold, right? Hello? Yeah. So it's
Yes, invest in gold,
and
silver,
also, and what's the
and there's
other
one
book?
on shrinking currencies lah.
Shrinking
It's
currencies,
about
right?
currencies lah.
All right,
Yes,
cool.
exactly.
So he has diverse experience in commodity as well as equity market. All right. So today we are very excited to invite you to come and share with our audience today. So now, without further ado, let me just hand it over to you as a presenter. All right. Over to you, Ian.
Okay, Shane, thank you so much. So now I'm gonna just click onto my screen. All right, so just give me a second. Okay, so I think everyone can see my screen, right? Okay, so this is actually the introduction slide. So first of all, thank you so much. I would like to thank Shane for actually giving me such a wonderful introduction. It's an honor to be speaking with Bursa Malaysia, and it's my honor to be back here for my second time. So without further ado, I've got a lot of contents with you. By the way, before I actually present what I would like you to actually prepare a calculator if you have a calculator, or if you don't have a calculator with you, please just stand by, get ready your smartphone, and get the calculator app right beside you, because we are going to do a lot of calculations today. And this session, right, it will be very educational for you if you are actually very participative. Now, without further ado, let's begin. Let's make it happen. Okay, so let me just kickstart with this basic stuff, which is the definition of PE ratio. Okay, all right. So for those of you who are new to PE ratio, so this will be an eye-opener for you. But if you have been investing for a long time, then I suppose this is actually quite basic, but please bear with me, all right? So let me just get through this very quickly. Definition of PE ratio. So what is PE ratio? PE ratio is actually called price to earnings ratio. So here is the formula. It's very simple. It is actually the stock price. Usually we can actually use the current stock price if you want to calculate the current price to earning ratio, and then you divide it by earnings per share. Okay, so let me just give you a quick example. So there are two examples, stock A, stock B. All right, so let's start with stock A. So let's say, for example, you open up Bursa Malaysia and you find out that stock A is actually, the price is actually 10 ringgit. It is actually earning $1 or 1 ringgit per share. So therefore, this is actually the PE ratio. So you take $10, 10 ringgit, which is the stock price, you divide it by 1 ringgit, and therefore you get 10. So very simple, right? So if you understand this, then we can actually move on to example number 2, which is stock B. So this is actually the current stock price, which is 20 ringgit. Earnings per share is 1 ringgit. So therefore, PE ratio should be 20. So I believe this is actually quite simple. Now the question is this, all right? Let's just warm up your brain a bit. So which of the two stocks, stock A or stock B, would you invest in? So Shane, can you actually see the response from there, or can I actually see the response?
Yeah, I can see the response. So for them who want to answer, you can type A or B, right? In the question
Yeah,
box.
you can. Yeah, just of course, I believe most of you will put stock A lah, all right, for those of you.
Okay.
But so do you see a lot of A's? I mean,
Yeah, I
because
see a lot of
it's
A's
just a
now.
warm up lah.
I see a
All right,
number.
so there won't. A number of A's lah.
Yeah.
Okay, so I think
only one person put B, the rest are A.
oh, like that lah.
Yeah,
That means I have to explain a bit lah.
okay. And there's one person
Okay.
answer C, so well.
There's only A and B. It's not a trick question, you know, all right? So it's just A or B, all right? Okay, so basically the answer should be A, yeah? But if you actually answer B, so I will just actually ask you, I will explain it with another question. So to actually explain why stock A over stock B, all right? So basically, as an investor, it is actually our aim to buy stocks with PE ratio. So here's why. So this is because we have another formula that I would like to introduce to you, which is called return on investment, all right, ROI. Okay, so basically it's very simple. ROI, the formula is like this, it is actually earnings per share. We actually divide it by current stock price, and then we multiply by 100%. Okay, so just now in stock A, all right, example, stock A, the PE ratio is 10. All right, because the current stock price is 10 ringgit, earnings per share is 1 ringgit, okay? Therefore, the ROI, all right, if you take $1, the earnings is $1, and then your investment is 10, multiplied by 100%, therefore, you should actually get 10% in ROI. Whereas in example 2, stock B, where we have calculated the PE ratio is 20, the ROI is actually 5%. Which means to say you take 1 ringgit in earnings per share, we divide it by 20 ringgit, multiply by 100%, therefore you get 5%. Okay, so this is actually quite basic, and this is actually why
I call this the earning yield, which is
earnings yield. Yeah,
which is inverted PE.
Correct. Exactly, Shane. Thank you so much. That is actually another way to call it earnings yield, which is correct. All right. So your return on investment or earnings yield will be high if you buy stocks with low PE ratio. So as an investor, you will actually want to buy, you are aiming for stocks with lower PE ratio. So just get that in mind. All right. I believe that this is actually, if you have been investing for quite some time, it will be quite basic. Just bear with me. I will actually go into something far more deeper, all right, in a short while, all right? Actually very soon. So just bear with me on that. Okay, now here I would like to address another thing here, all right, which is quite critical, all right. This is actually from my own pool of subscribers, all right. So whereby we actually where I found out that there's a what you call misleading conception, all right, between cheap and affordable, all right. It's not the same, but people are misled to thinking that both are actually the same. So let's do a simple, very quick example. Okay, so I'm gonna just go through this very quickly, and let's just answer this question now. All right. So I have stock C and I have stock D. Now the current stock price is for stock C is 20 ringgit, and for stock D the current stock price is 2 ringgit. Okay, so would you like? So just tell me, all right, just answer in the chat box, which of the two stocks would you think it is cheap, all right, and which one is affordable? Let's start with cheap. So Shane, do you have any sort of response? Hello, Shane.
Hi, sorry, I muted myself. I forgot. There are some B and
You muted yourself.
yeah, just not to interrupt you. So there are some C, some D. Yeah, it's a mix between C and D.
It's a mix between C and D lah.
Correct.
Okay.
Yeah, it's a mix between
So
C.
it's not like
quite balanced, quite balanced answer.
Quite a balanced answer lah. So I just moved back my screen a little bit to the first question, which is stock A and B. So it's a different question. So stock A and B is actually quite clear cut, right? Whereby which stock will you invest in? Most people will actually invest in stock A over stock B, right? Only one actually give an answer stock B, because most will actually go for stock A. Okay, but for C and D, which is another question, if you place a question like this, is stock C cheap or is stock D cheap? Then we get a balanced answer. All right, some say stock C, some say stock D. Okay, so if you want to know my answer, it's actually very simple. Actually, stock C is cheaper than stock D, despite stock C is priced at 20 ringgit and stock D is priced at 2 ringgit. So you may wonder, so the next question is this, you may want to actually ask, why is that so, right? Why is it that stock C that is 20 ringgit is cheaper than stock D, which is 2 ringgit? Doesn't make sense, right? So that is actually the starting point of understanding what is cheap and what is affordable, okay? Now, affordable is like this. You can actually afford more stock D because the price is lower, because the price is low at 2 ringgit. All right, you can buy more of stock D as compared to stock C. So that makes stock D more affordable than stock C. All right, so far so good, right? I believe. Now, when it comes to cheap or expensive, then you have to compare it with, in one way, if we are talking about PE ratio, we are comparing cheap and expensive in relation to its earnings. Okay, meaning to say, it is not enough to look at stock price first to actually determine whether a stock is cheap or expensive. We got to take into consideration of the stock's earnings to actually find out whether the stock is cheap or expensive. Now, for stock C, I've actually given the answer here. The PE ratio is 10. All right, so it's a very simple calculation. Take the stock price, divide it by earnings per share, and there you go. So for every dollar that you invest, all right, it will make you 10%, all right, or 10 cents, okay? So this is for stock C. Now, whereas for stock D, you take 2 ringgit, the price is lower, the earnings per share is 10 cents, your PE ratio is 20, okay? So if we compare it in terms of its earnings capacity or earnings capability, we will find that stock C is cheaper than stock D, all right? So I believe that you understood. I believe that we can get this straight, okay? So therefore, why people actually look not into stock price, but into PE ratio is simply because PE ratio is the ratio that tells you whether a stock is cheap or expensive. It is not the price, okay? So therefore, this is actually why people look into PE ratio. Now, who is this for? Okay, so just now we are talking about the basic. Basic means to say it's just the, just an introduction lah. All right, it's actually not exactly the webinar content that I would like to present for today, but it's just a basic so that we can actually get into the content. Now, the next question is this: who is this for? Who actually uses PE ratio? All right, so I would like to give a distinction between the two so that you can be very clear about how should we use this. First of all, PE ratio is actually for stock investors. Now, investors, what do I mean by that? Investors are people who are long-term in nature and they are actually investing into a business. They are people who are actually thinking about buying a stock and they would like to hold the stock for as long as they possibly can. All right. Just think of it like people like Warren Buffett. People like Warren Buffett would be most suitable, all right, when it comes to using PE ratio, because he's the type of people, the type of investor who will actually buy into a business and he hopes that the business will generate income for him, like for eternity, all right, for as long as you live on this planet Earth. So this is actually for you. PE ratio is for you if you are a growth investor. Means to say you have to buy into a stock whereby the stock is actually generating profits after profits year after year. And not only just that, it increases profits after profits year after year. So that is actually very important, okay? That's growth investor. Number two, value investor. Value investor is like this, all right? It's like people like Warren Buffett who always want to buy a good business, meaning to say the type that grows profit after profit year after year. And not only that, they have to buy it cheap, all right? And because they want to buy it cheap, that's why they look into PE ratio, not stock price. PE ratio, okay? So it's for you if you are a value investor. Number 3, buy and hold forever, self-explanatory. Number 4, passive investors. Okay, this is very interesting. Passive investor, what do I mean by this? It means that you are the type of investor who has a 9-to-5 job, okay? Or you have a full-time business, like for example, people like me, who has a full-time business running and stuff like that, who has no time to actually go and monitor charts and stuff like that. All right, you buy stocks to invest. All right, it is supposed to be it is supposed to replicate you. It's like stocks is like a clone. All right, like me, I'm running my business full-time. Stocks is another vehicle that generates income, all right, year after year, without you needing to put in any labor into it, and then you enjoy the fruits of your investment. All right, so it's for passive investors. All right, whereas active, if you're active, means to say active are like traders lah, all right, which is in this part of the category. Active means to say like you do a lot of buy sell transactions all the time, okay? So meaning to say you're always in and out of the market. All right, people like this spend a lot of time doing charts, doing all sorts of trading activities. It's like their own full-time job lah. All right, so if you already have a full-time job, keep your full-time job and make this as your secondary or third or tertiary source of income. Okay, passive investors. And of course, long-term capital is for you if you're going for long-term capital appreciation. Long-term means it can be forever. It can be a duration of, let's say, 5 to 10 years lah. All right, so this is for you. This is not for you if you're just purely speculating. All right, mean to say you're buying not actually PE ratio, right, is for people who are very profit driven, meaning to say you buy stocks to actually make money. All right, so you must have this mindset of show me the money. All right, where is the profit? Where does the money come from? All right, if I buy into this stock, it invests into some kind of businesses. All right, how does the business actually generate cash? Where does money come from? Who are the customers and stuff like that? All right, so when you're thinking in that kind of mind frame, you are actually quite profit driven. All right, meaning to say you are there to make money. Speculators, on the other hand, may not be there to make money. They may be there to find other things lah. All right, profit may not be at their core. I believe I've actually spoken randomly to some speculators. They may not be there for the money. They may be there for for some pleasure lah, for leisure, for some excitement and stuff like that lah. All right, so they could be after other things than profit. So P/E ratio will not be for you if you are not exactly profit driven. If you are a trader, then it's not for you, because trader will have a whole bunch of sets of technical tools, all right, where the technical tools are meant to actually help them to do short-term trading. So PE ratio will not be for you if you are a trader, all right? And of course, if you are a gambler, then there's nothing much to say lah. Gambler means to say they are there for gambling lah, all right? Means to say they treat stocks like lottery tickets or, like a trip to Genting Highlands lah, all right? So this is not for you if you have that kind of mind frame, all right? So if you are in this webinar, I'm very sure that you are very profit driven. You want to see where the money is. So stay tuned, all right? So this is for you if you're in the left side of the category, all right? Let's move on. So why do we use PE ratio, okay? Now this is very important, okay? First of all, the first reason why investors use PE ratio is this. It's because we want to save time. We don't want to invest in a stock that is losing money. Because if you look at the formula, P stands for price, E stands for earnings. In order to use this formula, the stock must be profitable. So if let's say the stock is making a loss, all right, let's say the stock rugi, okay, it has actually make a loss, kerugian in that particular year, then you cannot use PE ratio anymore, because you cannot calculate a stock that is stock's PE ratio if it's making a loss. So by using this, you're actually avoiding stocks that are not profitable. Okay, oops, sorry. Okay, so this is the first reason why people use PE ratio, is to avoid unprofitable stocks. And by doing that, you will actually reduce half of the risk of making wrong investment. You're actually avoiding yourself or preventing yourself from making poor investment decisions, all right, by just PE ratio. Number two, as mentioned, avoid profitable stocks that are overpriced. Okay, so of course, what we are aiming for is this: we are buying a business, an asset that is making money at the lowest possible price. So we use PE ratio to actually avoid overpaying for a stock. Very important. Okay, so that's why we use PE ratio. The third one is, of course, on the flip side, we use PE ratio because once we have actually spotted a bargain, which means an asset that is making money and yet is priced at a very attractive price, then we are interested, then we are all for it. So that is reason number three, is to actually help us find undervalued stocks. Number four, of course, we can actually use PE ratio to actually estimate a stock's intrinsic value. All right. So this is actually the content that I would like to present it to you. All right. This is actually less known. All right. And of course, if you read Warren Buffett's book, then it will actually tell you in detail how this calculation works, which I'm going to show you in a very short time. All right. But this formula is actually not widely known yet lah, because not many people actually read that particular page. It's actually hidden in the books lah. All right. So I'm going to just save your time on the books by doing a live demo. And of course, you can actually estimate your annualized capital gains from a stock before investing. All right, so you can actually do that with PE ratio. And of course, this is again something which is less known, all right, to the public. And all right, before I actually continue on, let me just say, a lot of people actually wanted to invest for capital gains, but the problem is this. When you ask them this question, all right, let's say I would like to throw you this question. So what do you want to invest for? Why do you want to invest in stocks? All right. So some say dividend yield, some say capital gains. Okay. So for those of you who are into capital gains, now here's the next question. So how much capital gains are you expecting in a year from investing in stock? Most of the time people couldn't gauge. All right. People say, hey, I do not know. I do not know if I invest in this stock, what's my capital gains like. All right, so here I will share with you a very simple trick to actually help you to estimate, so that you can actually do your due diligence before you actually invest in the stock. Very important. Okay, so with that, I'm gonna just go straight into the practical stuff. Just now it's all theory so now we are gonna go into the meaty stuff, the practical part, which is this. First of all right, in order to use this formula, I'm going to go into the intrinsic value and the capital gain stuff in a short while. Now, in order to do this right, the first thing to do is you must actually pre-qualify a stock. All right, a stock must be pre-qualified first in order to use this formula. So here I have actually placed a distinction. All right, what stocks are best when it comes to PE ratio, using PE ratio, and what stocks you can just chuck aside You don't need to use PE ratio. You can actually basically forget about it. Now, here we go. It is actually for stocks that have, number one, a stable business model. Okay. Number two, it has actually grown profits consistently. And number three, it has a future growth plan. All right. Why is that so? This is actually very important because, number one, we are investing for the future. I mean to say, for example, if let's say we are investing into a bank, 10 years from now, you have to ask yourself, will the bank still be a bank? Let's say this year is 2018. So by 2028, will the bank continue to be a bank? Very important, because some stocks, they are into certain business today, but in the future, they may change their business model. All right, they may change into some other sort of business. All right, so that is actually not exactly the kind of stock that you want to get into because what you want is a stable business model. So very important. Number two, it must have a track record of 10 years. All right, to be conservative. If you want to be conservative, take a 10 years of track record when it comes to profits. And C, make sure that the company is actually the type that has actually grown profits consistently. Very important. And number 3, it must have a growth plan. It's very important. This is because we're investing for the future, because past profits may not equal to future profits. So you may want to actually have an additional buffer by going for stocks that have a plan to increase their income in the future. And if the stock has a plan to increase income in the future, usually this will bring capital appreciation. Now, it's not for stocks that are as followed. Number 1, the profits decline. Number 2, inconsistent profits. Usually these are the cyclical type lah, all right, the commodity type of business. Number 3, the type that is not making money, made losses, poor financials and stuff like that. Number 4, short-term contract base. Okay, this one usually is like the type of companies where, you know, the contract is like 1 or 2 years and stuff like that lah. All right, so this 1 or 2 years contract may actually lead to inconsistent financial results. So you may want to avoid that. Number 5, stocks that are into developing rapidly obsolete products. All right, something like handphones, hardwares and stuff like that. Okay, because today you may be the winner, you may be the market leader in a certain type of product. Next thing you know, technology change, the product is obsolete. So you may not want to get into stocks like that. It's not for this kind of stocks lah, all right, when it comes to PE ratio. And the final one, which I think is very crucial, is this. The type that is relying on a few customers for sales, all right? So this one is actually very critical because let's say a stock actually has very good financial records, all right? It has a stable, I would say stable business model. Let's say it is into a business whereby it relies on a few customers and it has grown profits consistently, all right? The question is this: will the business actually continue to be profitable if the customer lari? All right, because after all, they are just relying on a few customers. All right, so it is actually a food for thought. So usually what I'll do is that I will make sure that the companies that I choose will have thousands or hundreds of thousands of customers, all right, paying good money, recurring money to the business, so that if 1 or 2 customers lari or what, it doesn't affect, or its impact towards the stock is insignificant. Okay, so make sure that you have a stable business model. Make sure you are into that mind frame. Okay, now with that, I'm going to do the live demonstration, which is I'm going to first share with you how to calculate a stock PE ratio. Next thing, the intrinsic value. I'm going to do that. All right, this is actually a simple trick. And the third one is actually how to estimate your capital appreciation before you invest in the stock, so that you can do final due diligence before you get into it. Okay, without further ado, let's let me get into my Google Sheet.
Excellent. Let's get the ball rolling.
Yes, this is the exciting part. Okay, now, finally, the theory is gone. Now I can do what I love to do the practical stuff. Okay, so now we have the first test, which is we need to actually pre-qualify a stock. Now I have 3 stocks, A, B, and C. Now all these 3 stocks are all these 3 stocks are real life stocks, all right? I purposely picked them for a reason, okay? So it has to qualify 2 things. Has it grown profits consistently? All right, has it grown profits in the past, for the past 10 years? As you can see, it's a 10-year data. Number 2, is it consistent? Okay, so
Ian,
can
you zoom in a bit so that the audience can see it clearer?
Oh, okay. Let's make it bigger lah. Is this good lah?
Yeah.
A little bit better, right?
Yeah. Excellent.
I should actually make it. Let's see. Let's put it to. Can I customize this? No. Okay, I think this should be good enough lah for the time being. Okay, so look at stock A, stock B, and stock C. Look at the earnings. Okay, tell me which of these 3 stocks, which of these 3 stocks is most suitable for you to use the PE ratio formula. All right. So Shane, what do you get? What sort of response do you get?
Well, waiting for them to respond. Yeah, they are 100% A.
100% A.
Yeah, and
Okay, fantastic.
one C. I think they are 20 over A's.
20 over A's lah.
Yeah,
Okay.
and
1C lah.
2C
2C lah.
and 1D.
Got 1B ah.
D. Donkey.
Okay. No donkey ah. There's
Yeah.
only three stocks only. I purposely
Okay.
picked them because
Okay.
these
Yeah, I know.
three are famous. All right. Okay. So if you go back to my slides, all right. So usually here's the thing. For those of you who answer A, I'm with you. All right. And I believe that you're listening well to my presentation just now. Okay. So yes, the answer is A. As you can see, the financial records are actually pretty clean. Earnings have been growing on a gradual, stable basis year after year for the past 10 years. Actually, you may ask, why 10 years? All right, why not shorter, 5 years? Why not 3 years, right? Because 10 years is used because throughout a decade, all right, there are always good times and bad times, okay? So it is actually a measurement of stability, of a stock's income stability. We want the stock to be stable when it comes to generating income. All right, which means to say, in good times, bad times, the stock makes money. Whether Barisan Nasional or Pakatan Harapan wins, it makes money. Whether ringgit is strong or ringgit is weak, the stock makes money. All right, it doesn't matter where oil prices go. Whether oil prices is at $40 per barrel or $140 per barrel, it doesn't matter. All right, the stock must make money. All right. Why do I say this? Because I have received a lot of questions. Say, Ian, Pakatan win already. How? What stock to buy after? What stock should I buy? Since Pakatan has already won, should I actually avoid the government company and stuff like that? So it's actually that's not the mindset of an investor. All right, that's more like speculating of what's going to happen in the future. So as I mentioned, this PE ratio thing is actually for investors who wants to invest for stable income. So meaning to say, all these market events, you name it lah. All right, elections, G14 or G15 in the future, oil prices, currency up, currency down, whether Bank Negara actually revise the rates and stuff like that. All these are inconsequential. All right. The most important factor is this: the stock must make money. Finish. All right. So if you are stock A, congratulations. All right. So I'm going to just review to you which are this. What are the stocks? All right. So stock A is actually public bank. Stock B is actually also quite famous. It is Hengyuan Refining. So I think because this was formerly known as Shell Refining lah. All right. So as you can see, Shell has a huge volatility when it comes to income. All right. Oil prices are volatile. Oil prices are up. Like now, it makes money. Oil prices tumble like crazy in 2014. If you remember 2014, then it make a lot of losses. Okay, so you don't want your income to yo-yo. All right, you want stable income, unless you're a speculator or you're another type of animal. Animal means breed lah, breed of people who are actually participating in the stock market. So animal is just my term lah. It's not meant to actually to be demeaning or what lah. All right. It's just my lingo lah. Okay. So if you're another type of how I say participant in the stock market, then maybe this stock is for you. But if you're the type who is going for stable income, then it's not for you. Stock C. Okay, as you can see, it is profitable, but the profits seems to be declining, all right, on a declining trend. Okay, so in this case, PE ratio is less useful, all right, as compared to the one that has stable income. So this is definitely not Hengyuan. This is actually YTL Power, okay. So for B and C, don't use this. don't use it for PE ratio. In fact, if you are the PE ratio type, you will always go with public bank and not Hang Yuan and YTL. Okay? Unless their business model improve or their profitability improve, then is to copy this data, and I have actually prepared a simple template like this, and then you need to just paste here lah. Okay, it's very simple, just copy and paste. Now I'm going to teach you a few more terminologies before we calculate the PE ratio. So this is earnings. So you may wonder, how do we get earnings per share? So here's the note. Earnings per share is this. It is earnings, the company's earnings, and then you divide it by the total amount of ordinary shares of the company. Okay. Now, all this information can be found in the annual report, but since I'm only given like 1 hour lah, so here I have done all the homework for you. I have actually tabulated, I have actually compiled the number of shares on a year-by-year basis of public bank, and this is as followed lah. So, like for example, in 2017, it has 3.86 billion shares lah. All right. Okay, so this is the amount of shares that you can buy. If you got all the money, if you get so much money in the world, all right, it's actually at 31st, the financial year end share price. All right, okay, you can Yahoo and download it, and you can compile something like this. Yes, if you want to buy 100% of public bank, you just take this and multiply by this, and then you will get the total price of public bank. So who wants to actually participate with me? How about this? Why don't we actually calculate, if you have the calculator with you, take this and multiply by this. So Shane, do you have an answer with you?
Let's see. Hang on.
Let's see. Anyone actually responded lah? So we take the share price of 20.78, which is the share price at 31st December.
No one responded yet.
We multiply by 3861. Let's see what we get.
Okay.
Got anyone
80 mil. Some say 80 billion.
80 billion. Okay. So that means if you want to, which is correct lah. All right. So thank you so much for responding. All right. I know it's a bit finger exercise or what. So basically it is 80 billion. So meaning to say, at 31st December 2017, if you're so rich lah, you can buy 100% of public bank Berhad. Then the price is 80 billion. Okay. So if you're that rich lah. Okay. But if not, then we have to buy, what's the minimum? 100, right? Per lot. Then we buy like a small percentage of public bank lah. Okay. But anyway, let's go back to the topic. So EPS is earnings divided by number of ordinary shares, and therefore this is the earnings per share, which is very easy. And now we calculate the PE ratio. Okay. So let's start off with 2008. Okay. So PE ratio is very simple, right? It's stock price. Yes. So let's just calculate. Let's just do one lah. All right. Let's just do one. Just to work your brain out. What is the PE ratio at the time of 31st December 2008, which is calculated by taking the share price at 31st December 2008, and you divide it by the EPS at 2008, which is 76.9. Any respondents, Shane?
Yes, 11.5.
Is it 11.5? Let's see. Yes, it's 11.5. Okay, so how about this? Let's do another round. This time we will go and do 2017. Okay, so we take 20.78 and we divide it by 1.417. So any respondents?
14.66.
14.66. Okay, correct. So for the time being, I'm gonna just I've actually done all the work for you. The past 10 years, which is as followed. Okay. Now, okay, this is what is most important. From this, right, we need three things. The first one is actually the lowest PE ratio. So from which, okay, from this 10 PE ratios, right, can you tell me which one is the lowest one? Which I think is this one, right? 11.51.
Yep. Yes.
Yep. And
Many
then the highest,
many
and then
answered 11.51.
and how about the highest?
16.71. Yeah, many answered.
Yes, 16.71. And how about the higher? How
The
about the
average.
highest? Okay. The average is, sorry, you see. Okay, the average should be 14.51 lah. So you just using Google, right? You can actually like yeah, it's actually blocked by this. I suppose it's somewhere around here lah. All right, so you can actually do a simple calculation, which is 14.51. Okay, so this tree is actually very important. Keep this in mind. So I've actually teach you how to calculate lowest average P and highest PE ratio. Now we need the current price of public bank, and I have actually inserted a link. So I'm just going to go straight to Google Finance lah because it's faster. So right now, as I can see, public bank Berhad, the current price is 24.02. Okay, so we are just going to take this figure lah. We're just going to put here. And then we are going to calculate the current PE ratio. The current means today's price one, okay? So what we do is we take the current price, which is 24.02, and then we divide it by the latest EPS. So the latest EPS is this lah, because 2017 lah. So any respondents if we, for the current PE ratio, which is you just take this one and you divide it by 1.417. What do you get lah?
Hang on, yeah.
Many people
16.95.
respond.
Many people respond.
16.95
Yeah.
Okay, fantastic. Okay, so I know it's a bit of maths, So as you can see, the current PE ratio is 16.95, right? Which is higher than the highest PE ratio ever recorded over the last 10 years by public bank. So in this case, right, usually the investors, right, usually investors will say, oh, this one is a bit on the high side lah. Means to say 24.02 is not exactly cheap lah, all right, because it is trading at beyond the highest PE ratio ever recorded for the past 10 years. So in this case, usually investors will just move on lah and find another thing to do, all right? They will actually usually buy if public bank is actually trading closer to the PE ratio of 11.51 lah. So if next time in the future, if public bank's PE ratio is around 10 or 12, then maybe yes, all right? Then yes, they may consider buying it lah. Usually they'll grab it, okay? So this is actually how you use PE ratio to do stock valuation. Okay.
Yeah, there's a question who asks you, how, at which juncture of time that you take the share price of 2017?
Okay. You mean where do I get this?
Yeah. Do you take it at the end of the year, or you take it at the middle of the year, or take it earlier of the year?
Okay. For that one, right? Because public bank the financial year end is 31st December. That's the cut-off date. So we take that date lah. If the cut-off date is 30th of June, then we take 30th of June lah.
So this is not the average price.
Okay.
This is the ending price, the closing price of the year end, of the financial year end.
Exactly.
I hope that answered the question. Yeah.
I think that should answer the question lah. Now, people know about this, so I'm going to just give it to you. So step one is very important, where you have actually pre-qualified the stock before you actually use it for PE ratio. Okay, so this is actually very important. Now, step two of calculating intrinsic value, right? all right, you need to calculate the growth, the past growth rate. Okay, so let me say, what is the annualized growth rate of the company's earnings for the past 10 years? Okay, so what is the compounding interest? So we need to actually calculate that. So in order to calculate it, I need to actually open up another, I need to use a CAGR calculator. Okay, so this is like a crash course to calculating the growth rate of the profit for public bank. Okay, so this is the calculator. You just need to go to investopedia.com, calculator /CAGR. It's a free tool, and I believe that I got a crypto. It's very simple. I've actually finished this one. Start value, which is this one. The end value, which is the 2017 figure. And then here it's actually for the interval is actually 9 years. All right, it's a 10-year data, but this is calculated as 1 year, 2 years, 3 years, 4 years, 5, 6, 7, 8, 9. All right, so number of years is 9. Okay, and then we are going to calculate the CAGR. Just put in the figures. Okay, just watch as I do it. So if you calculate, then you should get a compound annual growth rate of 8.7%. All right, which is this. All right, so what does that mean? That means to say from 2008, its profits, right? Public bank's profits are growing at a rate of 8.7% per annum over the last 10 years. Okay, so this is step number 2. Now, step number 3, we need to know what is the projected earnings in year 2027. All right, so we need to actually fast forward it for 10 years. Okay, and how much would public bank would be earning in 10 years? All right, if it continues to grow at 8.7% per annum. So let me say you buy now, the profits continue to compound on the 8.7% per annum basis. So what will be the earnings like? So in order to do that, I'm gonna okay. Now while I wait for this to actually look, okay, if you don't know which one to find, right, just go to the Google bar and just put calculator. All right, and just click onto the first one, which is this lah, Future Value Investopedia. Can't believe this is faster, but anyway. All right, it's around the same time. This is how you get the future value calculator, and it will come out with this kind of stuff. Okay, so interest rate per time period. We are going to use this because we are going to assume, all right, it's an assumption. Okay, assume means it may not happen in the future, but it's the best estimate from past track record. So we're going to take 8.7% and just put it in. So which is here, 8.7. Number of time periods. Okay, here we can put 10. Okay, so I'm going to just put 10. Present value. Okay, which is this lah. This is the present value because this is the latest earnings, right? So we are going to just put 5470. Calculate. All right, the future value should be 12,597. Okay, so I'm going to just remove the coloring. All right, so it is actually quite close to what we have calculated. But now we need to know the EPS of 2027, which is 10 years from now. Okay. So, okay, let me just explain a little bit. Let me go a bit slower. Meaning to say, so what does this mean? It means to say, now today public bank is making 5.47 billion ringgit, 2017. If it continues to compound its earnings at a rate of 8.7%, in 10 years' time, public bank will actually earn 12.602 billion ringgit. That's 10 years from now, okay? And the EPS, let's say public bank don't do any rights issue, no bonus issue, no nothing. It just remain its number of shares as of now, which is 3.86 billion shares. Therefore, your EPS for 2027, all right, should be 3.264 ringgit. Okay, so this is the EPS for 2027. Now, for those of you who are lost, don't worry. There's a half an hour question and answer session where we can actually explore this formula in greater detail. But for now, just follow. All right. So once we got the EPS for 2027, now we can actually estimate the intrinsic value of Public Bank Berhad. Okay, so current share price is 24.02. All right, don't worry about this. It's actually destined, how I say, pre-tabulated by me, pre-configured by me. Period is 10 years. Now, here's where the PE ratio, here's how we can actually use PE ratio. Okay, remember this, the lowest PE ratio, the average PE ratio, and the highest PE ratio. Usually we take either this or this. I'm just gonna copy and paste this figure and just paste it there. All right, for the time being, we can actually use the the lowest PE ratio, just to be conservative. So we just put it here. And we can actually tell what would the future price be like in 2027. So if we take EPS, we multiply by PE ratio, you will get the future price. Huh? How does it work? Okay, so I'm going to just write down the formula. Okay, let me just use this. Right. Let me just write an equation so that it's much more understood. PE ratio equals to price divided by earnings. So if you want to find the price, you need to take the PE ratio and multiply with the earnings. And there you go. All right. You just take this and just put it up lah. Okay. There's no visual aid for it, but just ponder about this particular formula for a while. It's a mathematical equation. All right. I'm just gonna leave this here. If you're a little bit slow in maths and stuff like that, you can just take a piece of paper and just jotting a bit lah. Okay, for your understanding. And let's calculate the future price. So make a guess. What would the future price be in 2027 if we take the EPS of 2027 and multiply by the lowest PE ratio ever recorded for Public Bank? What could be the minimum future price of Public Bank in 2027? Shane, any response for you?
37.56.
37.56
Yeah.
All right lah, close lah. All right. Pretty close lah, 37.57. More or less there lah. Okay. So congratulations, you have calculated what could be the future price of Public Bank Berhad in 10 years time. Is this possible? 37.57. Actually, if you look back, all right, let's go back to PE ratio and look back, right? Okay. So last time Public Bank is trading at $8, what? Just under $10. And 10 years ago, Public Bank was around $8, $10. Now it's around $20 plus. 10 years from now, it will go up to $30, $40. Hey, sounds very believable, right? As long as Public Bank continues to grow its profits in the future. It's believable, okay? Now, let's say, for example, you're interested to invest in Public Bank, okay? What will my annualized capital gains be? Good question. So I'm going to just take the compound annual growth rate calculator again, and I'm going to modify it, and I'm going to calculate. So beginning value is what I'm going to invest today, which is the current price, which is 24.02. The ending value should be the future price, which is 37.57. The number of periods would be 10 years because periods 10 years, right? So we calculate. So therefore, your annualized capital gain would be 4.57%, which is this. Okay, so ta-da. So therefore, if you're thinking about investing in Public Bank Berhad today, your annualized capital gain returns would be 4.57. Okay, and that is based on if the company is able to grow its profits 8.7% for the next 10 years, and you're using the lowest PE ratio ever, which is 11.51 as your basis of calculation. Okay, so the question is this: A, here the PE ratio is the highest. You say don't buy, but then here you say, hey, there's still room for capital gain. All right, so how? All right, so what should we do now? Okay, so here's the thing: why do we actually go with stocks with the lowest PE ratio, with its lowest PE ratio? Because if, let's say, for example, its lowest PE, let's say we take 20 ringgit lah. If let's say we take 20 ringgit as our basis, or let's say we cheat a bit lah because of time, we use this price 20.78 lah. So the PE ratio is this, 20.78. So as you can see, your capital gain returns, we can take 20.78. Your capital gain returns will be much greater in quantity. All right. So that means your money will actually compound at a faster rate if you buy stocks at a lower PE ratio as compared to when you buy it at a higher PE ratio. So this is why we use PE ratio. It's so versatile. You can actually use it to do a little bit of the simple investment decision, like should I buy now? Should I not buy? Now 16.95, don't need to buy now because it's actually at the highest PE ratio. You can actually use this to actually estimate the future price or the intrinsic value of the stock in 10 years time. And of course, you can actually use that to calculate or estimate your capital gain returns. All right. Now, of course, I should end my presentation, but I have the last bonus slide for you before we go into Q&A. All right. Don't worry, we can actually always get back to the what do you call the demo template and stuff like that for further discussions. Now I'm going to just share with you the limitations of using PE ratio. All right, because whatever valuation tools that you can actually use to guide your decision to invest, they are not exactly 100% perfect. All right, so now I'm going to list down the limitations. All right, so number one, there's no considerations for dividend yields. All right, that means say PE ratio is actually used widely to gauge the company's or the stock's valuation, whether cheap or expensive, based on its earnings, not exactly with its dividends. Okay, so this means say if the stock chooses not to pay you dividends, but it has low PE ratio, it's included. Okay, so you have a mixed bag of stocks that are both high and low in terms of dividend yields. Number two, there's no consideration of technical strength of a stock because this is not technical analysis all right. So if you buy at the price, let's say the public bank is trading at 11 in PE ratio, the stock price it has a possibility. It is still possible for it to drop in price even further. All right, because there's no consideration about technical strength. All right, and the third one is this: intrinsic value is always an estimate figure. It means to say whatever I calculated just now. You say I calculated 10 years from now the stock price of public bank may be 37.57. Is this an actual figure? No, it's an estimate. All right, because it contains a lot of assumptions. All right, assumptions like public bank growing at a rate of 8.7%. Who knows what will happen in the future? It may be more, it may be less. Okay. So the actual actual returns may differ, all right, from the estimate. And finally, there are absolutely no guarantees that the stock price will eventually hit the intrinsic value figures in the future. So that means to say, who knows what the future holds lah. All right, this is just the best guesstimate that one investor can do to ensure that it improves its investment success. All right, but it doesn't guarantee success. But it's better than nothing because you are basing it on past track record, not and your estimates or your your investment decision is actually based on facts which are proven, but of course with some educated guesses, rather than making an investment without any sort of facts and figures lah. All right. So these are the 4 limitations, and with that, I have ended my presentation. So with that, I'm gonna give back my control to the moderator. To your favorite moderator, Shane.
Yeah, all right. So we are now going into the Q&A session. I think Ian, you did a good job. So before we go to Q&A, let's do something fun, which is let's launch a poll. Okay, so on your screen, I'm asking you, how often do you use P ratio as a valuation metric? So please answer this question. All right. So for those of you who have question, please type in the question box. In the meantime, for those of you who are relatively free, let's answer this poll. Okay. So now we're in the middle of collecting response. Organizers and panelists cannot vote.
Okay.
Okay, we have over 50% have voted. Okay, in the meantime, if you have any question, please write down in the Q&A box, all right? Okay, 1 minute have passed. I have 65% of you voted. So let's close the poll and let's share the result. Can you all see the result? Ian, can you see the result? Yeah.
Oh, that's the result. Let's see. Yeah,
all right, I think I'm sharing it already, right? Okay,
so they are.
Yeah, I'm sharing it on the screen already. Do you all see it?
No screen.
Do you all see it? Just give me a minute.
Not exactly.
Not exactly. So let me read it for you. I think maybe I'm not a presenter, so they can't see. So there are 10% who use P ratio only. The other 70% use P ratio along with other valuation methods, and then 20% didn't use P ratio. All right.
Okay.
So here are the results.
Okay.
Okay, sure. Right now, I'm going to take back the control as a presenter, and then opening up the session for Q&A.
Q&A lah.
Okay, can you all see my screen? Hang on, yeah. Can you all see my screen? Okay, excellent. So the first questions that we have is just now when you talk about 10 years track record, right? What if there's 1 or 2 years that they miss? You know, it's not profitable, and you know, what would you do to the company?
Company, it depends when it exactly occurred lah. This unprofitable. Okay. So let's say, for example, it actually happened like long time ago, like it is actually exactly at the first of the 10 years, then it's then maybe you can forgive it. But if if let's say the loss actually happened at the middle, which means at the 5th or 6th year, then you can actually just abort it lah. All right. Usually because you see in Bursa Malaysia, right? We have a boutique of stocks, like 900 over stocks for you to choose. All right. So you don't have to actually, there are plenty of stocks that are actually amazing. They have actually delivered amazing sets of financial results. So why do you want to take risks on stocks that are not exactly profitable, or their financial results are mediocre or subpar? All right, so you don't have to take that kind of risk. All right, you can actually go with something which, and you have less. All right, you have less headache when it comes to that. All right.
So you actually skip that company lah if there's in the middle there's some break.
Skip low. Got
Yeah.
900 plus stocks to choose from.
Okay.
Somewhere it's just Malaysia, right? There's plenty of other stocks outside the country, right?
Okay. So the next question is, what is forward PE?
Forward PE, okay, this one usually it happens if you read, let's say, brokers analysis and stuff like that. So they will calculate PE. So basically, what happened is this. All right, they will take. How do I explain this? Unless I got a template lah. Shane, can you actually put it back to my screen, and then I open up
All right.
a template?
Okay.
Then I show you lah.
I made you the presenter now. Okay. Okay. Yeah.
Okay lah.
You're the
So
presenter
because
now.
this kind of thing.
No problem.
Okay, so now you're sharing. Now let's do forward PE lah. So basically, say we got how I say let's say we have Q1 2017. Not Q1. Let's put it March lah. I'm gonna just do it very quickly. Just bear with me. It depends how you. Oh, sorry. Let's see. Okay, so basically I have actually listed down very quickly 8 periods. All right, so all these are quarterly basis. Now, if you notice that, say this period is already in the past, okay, or this period lah, is already in the past, okay. So forward PE, all right, some of them they may do this. All right, let's say there's a figure here. Let's put a figure. And then I'm gonna just make a fictitious figure lah. 30. Okay. So basically what happened is this, okay. December 2017 has passed. March 2018 has already passed. But June 2018 haven't passed because we are now at June 2018, right? And then we have September 2018, which is in the future. All right. So these two are actual. So I'm going to just put actual. This one could be an estimate. All right. I do not know how the estimates are actually being carried out. I have no idea. All right. But what they do is that they take these 4 figures, which is 12 months. From there, they will calculate the EPS. All right, remember this formula? All right, you take earnings, you divide by number of shares, you get the EPS. So they will have an EPS, all right, which consists of 6 months of past figure and 6 months of estimate. And then from there, they calculate the PE ratio. So that, and if that, then you can call that forward PE. So that's my answer lah.
Okay, so you mean that forward PE ratio is a mix of past PE, actual PE, and the forward earning per share assumption, am I right? And then they do it in calculation. All right, so that answered the question. So now let's move on to the next question, which is how do we know the intrinsic value for 10 years from now? So like instead of knowing the intrinsic value for 10 years from now, how do we know the intrinsic value of the stock right now? Right now, can we use P ratio to gauge what is the intrinsic value right now instead of 10 years later? So that's the question.
That one, I think we need. That one, isn't that a masterclass?
yeah. Okay. To answer that question, in short, today it's not about intrinsic value, but Ian will answer that question in the webinar some months later, which is the intrinsic value masterclass. But to cut a long story short, the answer is you need to discount it back to the present value, right? So that one involves the assumption of the discount rate as well. So there's one more assumption that we need to make. But to understand more, please stay tuned to our intrinsic value masterclass. All right.
Okay, lah. Okay, I will just add on now, all right? Because in order to find out the intrinsic value right now, basically, actually, you can actually use this template, lah, all right? But then you need a little bit of modification. Like as Jane actually explained, you need to discount, okay? So now actually see, if you look at my screen, I think that Public Bank is actually will control its profits at 8.7% per annum for the next 10 years. So therefore, the next 10 years, the projected earnings will look like this. Okay? Now, this is the most important part. We need to actually discount it. It depends on what is the discount rate. So there will be a discount rate, all right, which will discount the what they call the projected earnings back to the present value, because money at this point is worth lesser than at point. All right, so that's why you need to discount it back. Then from there, you divide it by, after you add on the discounted projected earnings, you divide by number of shares, then you will get the intrinsic value. So actually, it depends, Shane, whether we have a lot of questions or not. If not, we can actually do
we have a lot of questions.
Yeah. Okay, then come back for the
please come back for intrinsic value masterclass some months down the road. Okay. Now, next question that we have here is, which is a better valuation method? Is it PE ratio or the price to book ratio?
This one is subjective. Income investors. Okay, first of all, we need to understand. About you, but for me specifically, it's about income. Okay, because income, number one, it brings dividends. So if you see my track record, of course, my dividend yield is about 6.5%. But anyway, if you're not into dividend yields, but into capital, higher income, higher stock valuation, higher capital appreciation. So it goes back to income also, all right? So if you're investing for income, then you got to use PE ratio, all right? Because PE ratio is a ratio specifically designed for people who are investing in a business that earns money. Now, if you use PB ratio, you are basically valuing a stock against the balance sheet of the stock. The balance sheet means what it owns deduct what it owes. All right, so you will have the net worth of a stock. So that means, say, for instance, let's say you have a house and it's worth $1 million, and then you have a mortgage of $500,000. The property equity, the net equity is $500,000, and then you can actually, if you actually buy it at 400,000, which is ridiculously low, then you'll get yourself a discount something like that. So that is PB ratio. All right, so it's a different kind of valuation method for a different kind of purpose. Usually PB ratio is for stocks that are asset heavy, not asset light. All right, usually it's for asset heavy stocks, like plantation, like you can use it for REITs. You can use it for REITs. It's actually quite useful.
REITs, okay.
Banking sector also can.
Yeah, I think banking and property development, I think we look more at the price to book value. Yeah, it's more asset heavy.
You will look both Yes.
Yeah. REIT, do you look at PB ratio?
REIT, of course, we look at PB ratio That one is also quite important. All right, because actually we want to be more inclusive. We want to be more inclusive in our assessment of a stock deal because if it's for REIT, right, we want to look at dividend yield, because REIT, they pay out nearly all its earnings as All right, then only we can call it a REIT. So usually we just jump straight to dividend yield over PE ratio lah.
Yeah, yeah, yeah,
All
yeah.
right, PE ratio is for stocks because some stocks like public bank, they only pay like 50% of their earnings,
Yeah, yeah,
usually
yeah.
45% lah. So then you use PE ratio lah. All right, if not, like REITs, you can use dividend yield and PB ratio. Actually, you can use PB ratio for public bank. So I think that should answer the question, right? Use it
Okay.
for asset heavy kind of stocks.
Okay. So the next question is, can we say that the P ratio cannot be applied to cyclical stocks?
Best not to lah. All right. If you want to use that to calculate intrinsic value, then don't lah. All right, because you need to actually, because cyclical stock means to say, okay, so that goes back to the objective of investing. So why do you want to invest, right? You want to invest to actually get a stable secondary source of income so that it can supplement your daily needs, or to actually fund your future retirement and stuff like that. So if you are actually looking to make money consistently in the stock market, then you have to buy something which is consistent. All right. So you will not actually go into stocks which is cyclical, because cyclical stocks, the income will go like yo-yo. All right, will go up and down, and then you are playing a game of chance. Because let's say, for example, you get into an oil and gas service company, and then if let's say the company makes very good money in when oil prices are high, because there's demand for oil and gas services, and then when prices are low, like oil price is low, there are lower demand of oil and gas services, then you have lesser income. So you can't. So if your objective is to invest for consistent income, then you shouldn't get into this kind of companies lah. Or why do you want to take a chance on a yo-yo company?
All right.
So it's very important to understand the objective of investing.
So it all depends on the investor themselves. Okay. So
yes, of course lah.
Okay, so the next question that we have is, do you think going to buy low PE ratio, or you usually go into a sector average that would make more sense?
It depends. Actually, it depends. Okay. So I would usually look at individual. It makes more sense. Okay, so let me just go back to my slides.
Yes,
I
please.
got something to show you. Okay. Now, supposedly we have this definition, right? Now we have stock A and then we have stock B. So stock A, PE ratio is 10. Stock B, the PE ratio is 20. Now, of course, we will go with stock A because stock A is cheaper, all right? Because PE ratio 10, ROI is higher, or earnings yield are actually higher. Okay. Now, to your question, let's say I have a sector where all the stocks have very high PE. All right. Let's say I have 3 stocks, all making good money, and then stock A, the PE ratio is 35. Stock B, the PE ratio is 40. Stock C, the PE ratio is 50. So does that mean that I should actually invest in the stock that is priced at 35? Because it is the lowest amount in the same sector. All right. But if you calculate the earnings yield of the lowest PE ratio, which is stock A in that sector, which is 35, all right, then you will get a very, very low earnings yield. So it doesn't make sense. It doesn't make business sense anymore. All right. So you can actually do that as a guide, but ultimately it is when you invest, you're not investing in a sector. You are buying shares of a specific company. Let's say you are buying into public bank, then your income will be derived from public bank, not from every other bank in Malaysia. It's just public bank. So I believe that you can use sector PE as a guide, but you can't use sector PE ratio to calculate intrinsic value. At the end of the day, the individual PE ratio, the individual stocks PE ratio will carry a lot more weight than a sector PE ratio. So that's my take lah.
Okay, so maybe they just look at the sector as a benchmark lah. Maybe are they below the industry standard? But anyway, let's go to the next question, which is the question on how come some stocks can fetch a very high PE ratio like 40 to 50, while the other stock could probably stay at very low PE ratio like 3 to 5.
Okay, good question, right? It's a famous one lah. Alright, let's say like my EG lah. Ratio before GE 14, the PE ratio is about 46. You know, so why would people actually bother to buy a stock that has a PE 46? What kind of earnings are you going to make? Stock that is trading at such high PE ratio, but people buy because they did not actually attend this webinar.
Yeah, precisely. Yeah, precisely.
Helpful that you this webinar so that you don't get yourself into a stock whereby the PE ratio is anything beyond 20 lah, okay, or 30 or 40 or 50, because your earnings yield or your ROI will be very low if you buy a PE at a PE ratio of that quantity. If you are buying into that, you are actually speculating. You are thinking that PE ratio of 40 will jump to 70. I do not know. Okay, if that's your game, then I wish you the best of luck lah, because usually stocks don't go that high lah. All right, in Malaysia lah. I'm not talking about the US. Okay, but so that's why. All right, that's why what I'm saying is that's why if you look into logic, into common sense, you won't actually get into that. All right, so back to your question, why do some stocks actually can go up to 46, 30, 40, 50 like that? Because they never some people into the stock market, usually the ones that are late, they actually never calculate the stock's PE ratio in the first place. All right, so because of that, right, they will actually buy into stocks, into such stocks lah, you know, because they never really calculate. They think that the stock price has actually gone up, they buy lah, you know. They don't exactly do due diligence or what. They just buy because they buy lah. There's no logic in nation. That's why sometimes investors will get the highest gain, because we try to buy at low PE ratio, that's at 10, that when stocks are hitting ratio 46, we sell lah, to actually reap the best capital appreciation, even better than speculators. So that's Warren Buffett actually make tons of money, in fact billions, all right, because he knows to PE ratio. Why some stocks are trading at PE ratio at 3 or 5? Actually, very rare you find stocks that are trading at 3 or 5, unless there's something wrong with that company lah.
Heng Yuan
all right, Heng Yuan, because Heng Yuan, the problem with Heng Yuan is the stocks are not consistent. All right, the stocks are not consistent. So some people are getting into it. Some people like me, conservative, get into it because so that's why it affects the PE ratio. All right, because if you calculate the PE ratio of Shell refining at 2014, it's negative. We won't actually look into it because it's not making money. Here, the PE ratio is 2 or 3. The thing is this: can it continue to make that kind of money in the next 2 or 3 years? So this is actually something to think about, because we never know how will oil prices be, or where will oil prices be over the next 10 years. All right. What is more certain is that oil prices will continue to yo-yo over the next 10 years. It will never stay at 70 or 80 US dollars per barrel for the next 10 years, like flat, as if there's nothing going on the market. All right. It could go up to 100. It could come down. I don't know. So because of this huge uncertainty, so it drives away investors who are seeking some form of certainty when it comes to income. So because of lower demand, so therefore the PE ratio is lower. So that's what I can think of right now lah.
Okay. So the next question we have here is, Ian, are you able to send them? I mean, the question who asked is, can you send them the Excel sheet or not?
Can lah.
I mean,
But
you
then,
can.
here's the
If
thing lah.
you are able to send it, maybe you can post it in the chat group here.
Let's see, chat
You
group
share the if you're able to.
should be this lah.
I guess so. I guess so. If you're able to share, okay. If it can't work,
try,
then yeah, can you please try in the chat box if you're able to share, okay?
So this is chat, right? So is it to all lah? Is it or
Yeah.
send to who?
Send to all.
Organizers and panelists, or
Send to all attendees.
there's no all lah.
There's no all, is it?
Or live chat.
Yeah, never mind. You send to me, I will send to them if they are able to get it. For those who need it.
Okay, let's try. So here lah. Okay, so I've actually posted up. So
okay, let me copy and paste there. All right, sure. Let me see. Okay, you all see the link if you need it. All right, so I think our speaker today, Ian, is so gracious to share his work with you. All right.
This is by far the most important question ever.
Yeah, there are a number who ask for, there are a number who ask for the template though. All right, so I think we have probably coming to the end of this Q&A sessions. So this is a gift by the speaker to you all, and let me take back the control. Just give me
sure.
All right, so today I think we have a fruitful session talking about PE ratio. We delve deeper into how we can calculate PE ratio, how to use it, what are some criteria to use it, and at the same time, why some stocks fetch a high PE and why some stocks fetch a low PE ratio. Now, before we tell you the next session, let's talk about what are some recent changes to the stock exchange. Now, we have a waiver fee on waiver on clear and trading fee. I think some of you will have known it. So all new investor, if you haven't had any CDS account, if you open a CDS account, you'll be given a fee waiver for trading and clearing fee for the next 6 months. All right. So effective 1st March 2018. And then for those of you who want to go into mid or small cap stock, you will be exempted from paying stamp duty for a period of 3 years. For those small and mid cap stock, no need to pay for the stamp duty. And you also have stamp duty for contract notes and stamp duty for contract notes for ETF and structural warrants will be waived as well, effective 1st of January 2018 for the period of 3 years. And lastly, the most important update for this month is 0% GST for Bursa Malaysia. All trading fees charged by Bursa Malaysia will be subject to 0% GST effective from 1st June 2018. All right, so this is a new promise by the Pakatan Harapan government. So yeah, most of all, no GST anymore. All right, so this is our next webinar. So the next topic we're going to talk about warrants 101. So for those of you who want to learn how to trade structural warrants, company warrants, please join our session on 3rd July, 8:30 to 10 p.m. Registration link has been sent in the chat box. All right, so we'll see you next month. With that, I want to thank all of you for tuning in to this webinar, and thank you so much, Ian, for becoming our speaker today. We really appreciate you sharing all your nugget of wisdom with all of us today. And with that, thank you very much. And this is Shane Chu signing off from Bursa Malaysia webinar. Thank you, guys. Have a pleasant rest of the day.